John Bogle was the founder of the Vanguard Group and a major proponent of index investing. He was commonly referred to as Jack. John Bogle revolutionized the mutual fund world by creating index investing, which allows investors to buy mutual funds that track the broader market. He did this with the overall intent to make investing easier and at a low cost for the average investor. Bogle introduced the Vanguard 500 fund, which tracks the returns of the S&P 500 and marked the first index fund marketed to retail investors. In this video, we are going to take a look at why 99% of people don't get rich, and one of the easiest ways for people to do so. Make sure to watch the full video to hear what Jack Bogle had to say about index investing and becoming rich.
Is it appropriate, in your opinion, for an individual to buy stocks? Is there a level of expertise or interest, an amount of time you should have, or capital, or it should be a side frivolity in a base portfolio of index funds, etc.?
That last sentence captures it best, and that is, you should have a serious money account. I might even call it a boring money account, where you put money in the stock market index fund and balance it out a little bit with some bonds, depending on age and so on. And don't look at it. Don't look at it for 50 years. Don't peek. But when you retire, open the envelope. Be sure a doctor is nearby to revive you. You'll go into a dead faint. You can't believe there's that much money in the world.
One of the biggest reasons why people don't get rich is because they do not want to wait a long time to get the money. A lot of people say that they want to be a millionaire now and not in 30 years, but instead of investing tiny amounts into an index fund, they never start and never end up rich, even when they are old. People don't understand the concept of compounding money over time, and they don't believe that they can have many millions at an old age. As Bogle said in the video, start off with most of your money in index funds, keep adding more money when you can, and don't look at your account for many decades. When you are retired, look at all the money you have. It will most likely be more than you could ever dream of, at least that is what has happened historically. John Bogle and passive investing. John Bogle contributed significantly to the popularity of index investing, in which a fund maintains a mix of investments that track a major market index. Bogle's philosophy that average investors would find it difficult or impossible to beat the market over time led him to prioritize ways to reduce expenses associated with investing in mutual funds. For example, Bogle focused on no-load funds featuring low turnover and simple investment strategies. The philosophy behind passive investing generally rests upon the idea that the expenses associated with chasing high market returns cancel out most or all of the gains an investor would otherwise achieve with a passive strategy that relies upon funds with lower turnover, management fees, and expense ratios. Passive investing stands in contrast to active investing, which requires managers to take a more hands-on role with the intent of outperforming the market. Index funds fit this model nicely because they base their holdings on the securities listed on any given index. Investors who purchase shares in index funds gain the benefit of the diversity represented by all the securities on an index. This protects against the risk that a given company will lower the performance of the overall fund. Index funds also more or less run themselves, as managers only need to ensure their holdings match those of the index they follow. This keeps fees lower for index funds than for funds with more active trading. Finally, because index funds require fewer trades to maintain their portfolios than funds with more active management schemes, index funds tend to produce more tax-efficient returns than other types of funds.
I'd say have a funny, if you have the gambling instinct, and most people do, at least start off. I'd say start off with an index fund, period. And for 5 years, don't do anything else. And then look around and see what's happened in the 5 years. See how it felt when the market dropped 50%. See how it felt when it came back. And those 5-year periods are going to be very different for one investor and another, but because they're all over time. But then when you get there, 5% in the funny money account.
What would have happened to Warren Buffett if he had done that? He would have, a tremendous amount of value would not have been created by his understanding and ability to evaluate a business for investment.
Well, name two.
Well, Longleaf, you mentioned Longleaf, dodging Cox.
But they don't have the sensational returns. They may probably have something above par returns, but maybe a little bit below par from time to time. Mm-hmm. So, and then don't forget in Warren's case, he wasn't running a mutual fund. Mm-hmm. The mutual fund is a badly structured business for investment management. We say, and this is the way it has to be really, you can take your money out whenever you want, and you got to be ready to put it in whenever you want. And so you ride on these waves of optimism and good performance, and the money comes in up here, and then reversion to the mean, which is a big part of my recent book, a big part of the final chapter of my recent book called Clash of the Cultures, and it's happened everywhere. It's happened in Magellan Fund. It's happened in T. Rowe Price Growth Fund. It's happened in our old iVest Fund. It's happened in Fidelity Trend Fund, which Ned Johnson happened to have run. It happened in CGM, all the hot funds. They were all in there for the last 25 years, and they all look like this. You put them over each other, looks like the Himalaya Mountains. The reversion to the mean is a constant pattern.
For the individual, I'm just going to poke around here a little bit just to get your full philosophy. For the individual, it's unlikely that you're going to hit the mountaintop of the Himalayas with your portfolio. So you may not have to ever see the other side of the mountaintop unless you have so successfully invested that your personal account is moving up in the $1 billion.
Let's say you bought Magellan before it was for sale, which is where that record begins, by the way. There's a lot of phoniness in this business. But you're going to enjoy the mountain. And you're not going to know it's a mountain. But when that mountain gets up there, you think, my God, I found the Holy Grail.
Now I'm really going to go all in.
And now I'm going to go all out. So there's a lot of behavioral kind of stuff, not to use too fancy a word, in the mutual fund industry. Interestingly enough, Tom, there is no behavioralism in the field of stocks generally. How could that be? That is because I'm a dumb behavior. The guy that buys my stock from me is a smart behavior. We offset each other. I mean, it's not as if I can make a behavioral mistake without somebody else making a successful behavior thing, the other side of the trade. So I think we take a lot for granted. We listen to all these theories, and big, old, boring indexing is the answer.
Have you ever bought individual stocks and or actively traded funds? And if so, what do you look for in those investments?
Well, when I came into the business, I had friends in the brokerage business, and I bought this and that and the other thing. And then I had a broker. And he would tell me this was good, get out of that and get into that. And it wasn't that they did badly, which was, of course, what they did. But it was, I just couldn't stand to have my phone ring when I was trying to do my work. So I haven't owned an individual stock since, let me say 1960, I don't know exactly, a long, long time.
That's it for today's video. I hope you enjoyed it and learned something new. Make sure to like this video and subscribe to Compounding Club because it helps out the channel a lot. Thanks for watching the video, and I'm looking forward to speaking again soon.